Hello and welcome to another market update. Today is Monday the 29th of September. I hope you're enjoying your school holidays if you have started to holiday and go on any trips. Otherwise, probably just powering through. We do have a long weekend coming up next weekend, so I'm looking forward to that, and the weather looks like it's going to be phenomenal for that as well. In any case, top three things today are going to be RBA and inflation and the upcoming interest rate meeting or interest rate announcement. Number two, volatility and what's happening in the volatility regime. And number three is the quad count. We're exiting now September, about to enter October and November, December, and I just want to refresh for you what the quad count is looking like for the next 3 months, how we're set up, and of course what to expect in those quads. Plus I'm going to hit on a question that I got, a really good question that I got from some clients recently around credit crises, and have a quick chat about that. It should be a relatively short update today, so let's jump into it. Quickly talking about the RBA. So again, next week, Tuesday, we have an RBA rate announcement. I don't think we're going to see any additional rate cuts, simply because we've had an reported inflation number in Australia that has suggested a bit of an acceleration in inflation. So I think the RBA is going to maintain a fairly cautious stance. I don't know that they would really have a good reason to cut rates. The economy is doing pretty well. Inflation's showing resiliency and even an uptick. And so I think the RBA is going to not do anything. We'll just have to get there and see what happens. I think the currency market will probably tell us a little bit about that when we get closer to the date. And by that I mean we should watch the movements in the Australian dollar versus the US dollar. If we see the Aussie dollar coming down, that's probably going to signal that we're going to get a rate cut. Oftentimes, though, I have in my observances of the Aussie dollar around rate announcements, it tends to do some things initially, and sometimes the RBA comes out with something completely different than what the currency market might have thought was going to happen, and then we see a reversal. So whilst it's something to watch, and it'd be interesting to see, if the currency starts to move up a little bit, it could be a sign that something's been leaked and there's not going to be a rate cut. If the currency is moving down, then it could be a sign that, again, there's been a leak as to what they're going to do, and we're going to get a rate cut. Anyway, we'll just have to see what happens. But I do want to highlight for you that in the U.S. we are seeing still a reacceleration of inflation, and this chart that you see on your screen here is all about that, and the fact that we have seen, again, just to refresh in case there's anyone who is new to watching these updates, inflation is one of the three key macroeconomic factors that we look at. So the three macroeconomic factors are growth, or GDP, inflation, and interest rates. And we want to figure out the direction of those three things, because the direction of those three things puts us in a quad. And based on the quad we're in, that is how we want to set up our investment portfolio to take advantage of that. So in the US, we have continued to see this acceleration of inflation. Now, the last time I showed this, I think this middle number here was 3.19, or maybe 3.2. That's come down a little bit. Doesn't really matter. The point is that there's going to be an acceleration. This is for the September period, so we won't get this number for September until, I think, mid-October. Nevertheless, it's going to be continued acceleration, which again should take any additional interest rate cuts in the US off the table, and we will continue to see, I think, certain asset classes performing well that do perform well under these conditions of inflation. So assets and commodities tend to do well, or better even, during these periods of inflation. So just to quickly recap, I don't think there's going to be a rate cut next week in Australia, and we have continued inflation in the US, which continues to support this transition from quad 3 to quad 2, which I'll talk about in just a moment. Before I do that, though, let's hit on volatility, because the volatility regime is something that I just wanted to again refresh. This is a nice little summary document that I get from Hedgeye each week, and they have a gauge here, which is a fantastic gauge. It's what, of course, I always talk about. We have 3 buckets of volatility: investable bucket, which is what we're in right now. I don't know if you can see that. Just blow it up a little bit more here. That's where volatility. This is the VIX, the VIX, which is the S&P 500 volatility measure. When it's between 9 and 19, that's the investable bucket. So if volatility, it can move around that range, that's fine. 9 to 19 is okay, but that's the investable bucket. That's where we can absolutely continue to be fully invested and really not worry too much about it. The second measure of volatility is a chop bucket. That's 20 to 29 vol. And again, you can still typically be fully invested, but that might be where you might want to trade around positions if that's which I don't do with client capital, because we want to just keep our investments fairly set. But that's where you could trade those volatility events and make good money. And then this is the F bucket, which is volatility at 30 plus. That's where you really need to dial down your risk exposure and not have much exposure to the market. Good news is that volatility continues to be, and this is a chart of the VIX, and this is a daily chart, and it goes back to, what's happened to it? It is thinking, there we go. It goes back to about early August, where we've had, actually, no, I'll go even further back, where, as you can see, this is back to, well, really February of last year, but we've had these periods of time here. I'll make myself smaller. Where we've had big spikes in volatility, where there's been some event, something's happened in the market, big spike in volatility. This would be a great example right here back in August of 24, where we were absolutely in the uninvestable bucket. We spiked up above 19. I mean, vol clearly had a huge spike on whatever trading day. This was the 5th of August, where it went up to a high of about 65 in one single day. Just insane. Came off fairly quickly, but again, didn't stay low for long, and then kind of bounced around. Another spike in earlier this year in April, where we had a big spasm in the market. That was around all the tariff stuff, and then we've pretty much just gone into a low vol investable bucket regime. So all you need to really know is that we're going to continue to see these periods where we have a little bit of a spike. We stay in the investable bucket. Again, this is an opportunity to buy stuff. This is an opportunity to buy stuff, which I have done. You would have noticed on those daily reports that you will see that come through from Interactive Brokers. For those of you on IB, I'm typically buying stuff around those times. If you are on the Hub24 platform, that platform doesn't really enable me to take advantage of this kind of stuff, and we have a rebalance that occurs in those accounts, usually on a monthly basis. So in any case, the volatility regime still applies in both cases, and changes are made depending upon the volatility regime in both cases. I talk about volatility a lot because it's an important market measure, and that's why I talk about it. Finally, we're going to talk about the quad count, and again, this is a really tiny little table here, but we've now come out of the September period where we had a quad 3 on, and monthly quad 3, which absolutely has happened in spades. That is a really a stagflationary environment where growth is a little bit suppressed, but we see inflation continuing to rise, and interest rates are typically staying at or even sometimes slightly rising, but usually they're just flat. We're now transitioning into this quad 2 environment, so October will probably be a real ripper of a month for equities, and we've continued to see the market repositioning itself from being, and again I'm going to use some technical terminology here, but net short in certain areas of the market like the Russell 2000. All that means is that the punters out there believe that maybe there's going to be some sort of market crash. I don't know, so they're short the market, or they have less exposure to certain parts of the market. That's been wrong. We have not had that exposure because we know how to read data and signs of market activity to tell us how to invest. And so the month of October is going to be good. Then we're just going to bounce back into a quad 3 in November. And then this is the one here that could be interesting in December, is to see what happens with this quad 4. Now, it will not be a panic station. It's not going to cause us to be worried about any follow-on from whatever happens in the market in December because of this quad 4. I would expect there to be probably a little bit more volatility. Certain asset classes aren't going to do particularly well, but then if we look at what's coming down the mountain in the first 6 months of 2026, we've got a lot of quad 1 and 2 activity and quad 3. So very good environment to be an equity investor. So we'll just have to get through December and probably not make any big moves there, but I'm going to get to November, see what's transpired in October, see how the market is responding in November, and potentially make some changes to portfolios in late November, anticipating this quad 4. There's a lot of water that'll flow under the bridge between now and then, so we'll see what happens. Okay, that's a quick market update for you. I do want to touch on this question, which I thought was a very good question, and it basically is around how do you, well, the question was around, are we going to have a credit crisis? And then B, what are the signs that we could be entering a period where there will be a credit crisis? So what is a credit crisis? Well, if you think back to the period of the GFC, which is 06, 07, that was a credit crisis. The issues with that eventually infected the entire housing market and the stock market and everything started in the bond market or the credit markets. And credit and debt are kind of interchangeable terms, by the way. So when you talk about credit, you're really talking about debt, because credit is debt. If that makes any sense. Hopefully it does. And so the question was around that, and then my response was that there will be signs in the credit market or the debt market that we have problems brewing. And one of those signs, and I'm just going to go to a chart that is a volatility measure of the bond market. Make myself small again here. One of the things that we will see in the bond market is an increase or a huge spike in volatility. Now, this particular index is called the MOVE index, and this only goes back to 2023. So what you can broadly observe here is that the bond market volatility, which was elevated from back during the COVID times, really started to decline. We did have some other spikes in bond market volatility that, again, didn't really precipitate into any other issues. But this will be one of the things that we will be watching to see with increased volatility in the bond market. Again, that's usually one of the signs that there is something brewing as far as a credit market event. The other thing that happens is we see high yield volatility increase. And so this would be, when we talk about high yield markets, we're talking about private credit, so non-government backed debt securities. So we're not talking about treasuries or anything issued by the U.S. government or any other sovereign type of debt. We're talking about those commercial credits that might be issued by a big company like, for example, IBM or Amazon or someone like that, because they do a lot of borrowing in the private credit markets, and other company specific or company related credits. And volatility in those spaces absolutely starts to rise, and we see spreads get very spreads start to increase. So what is a spread? So the spread is the difference between the high yield credit and, say, that government debt. So when that spread starts to increase, and it could be 3, 4, 5, 600, 700 basis points or 7% over, say, a government bond, that's when you know there is potentially some trouble brewing out there. Now, this table is a little bit confusing here, and really what I want you to focus on is the black line, which is the volatility of this market. And the volatility in the bond markets is generally pretty low because they're fixed income securities. And right here is where we are today. This is a volatility measure that is very low. So this is good. So on the left side of the chart here is the volatility, and you see that it's quite low. We did have that spike back in the April period where there was all this tariff stuff, and people were really actually quite worried about companies' profitability because of what Donald Trump was proposing with tariffs. And if you think about it, that proposal around what he wanted to do with tariffs and increasing all these tariffs meant that company profitability might be a lot lower. And because of that, they might not be able to pay their debts. And so that's why you saw this big spike in volatility, but only for a month, and then it came right back out because a lot of the tariff stuff, I think, was overblown. The administration started to walk that back and signal that they weren't going to be, too, I suppose, too non-negotiable on things. And you saw, again, that volatility come right out of the market and right back down to very low levels of volatility. So to wrap all that up and really just make the point, the question is about, will we see signs of an impending credit crisis or a developing credit crisis? And the answer is yes. And what I've just walked through is some of the things, that we will look at to get a gauge on whether there are concerns and whether we need to make changes to positioning in portfolios. So that's kind of cool. Markets provide a lot of information about the economy and everything else. I mean, if you want to talk about a huge AI machine, which is actually based on real human behavior and intelligence, it is the stock market. It is the bond market. Watching and observing what those things do tells us a lot about the future. With that, I'm going to say have a fantastic rest of the week. If there is anything I need to update you on later this week, I will. But certainly next week, I'll probably wait until we get the RBA decision on the Tuesday. Monday's a public holiday anyway, so I'll leave a market update probably on Wednesday of next week. With that, have a good one. Enjoy school holidays. Talk soon. Bye-bye.